Hey everyone, it's Sean here. The information that you're about to learn on this video tutorial is extremely beneficial to you. How many times have you asked questions about the expenses and charges and fees and gotten the runaround from a financial planner or a financial expert? How many times do you wish that you could just talk to someone who really understands this stuff and still get answers to the questions that you have about various products and cost structures and all of that stuff? Well, the expert that I'm interviewing today has a 30-year successful track record on Wall Street. He sits on the board of directors for companies with assets in excess of $30 billion, that's with a B, and he has extensive knowledge in the structured financial products industry. He holds several SEC licenses. Now, because of his rank and his stature in the industry, he's requested not to be identified, so we're going to honor that request. He's agreed to open up the kimono and kind of talk about the different structured life insurance products and how the insurance companies make money from them. Now, the reason this is so important for you is because we structured these accounts very specifically for the reserve capital strategy. Now, not everybody understands this and how it applies to the structure of your account. And of course, not all accounts are the same, as you'll soon find out. What I'm about to share with you is extremely important to you and your personal economy. You'll want to take good notes, so get out a pen and paper, get ready, and let's jump into the conversation.
Well, let's approach it from this point of view. My dad was a very challenging man, and that he had a number of sayings, and his sayings always were very pithy and to the point. And I remember coming home with a report card that had a couple of B's on it. Mm-hmm. And he felt that I had the ability, and the reality is I did, to make A's, but I didn't. And I remember telling him, well, those are pretty good, Dad. I mean, they're B's.
Right.
And what he said, Sean, was, well, that's true, but the good is the enemy of the best.
Interesting. I like that.
And so with that in mind, under the right circumstances, IUL, Index Universal Life, is a good product, but there's a better product out there, and that's Whole Life.
Right.
And so if the good is indeed the enemy of the best, why would a person, if they could have the best, why would they end up with choosing, knowing with full disclosure, full knowledge, full information, why would anyone accept something good if they could have what was best?
Sure.
And so from that perspective, I think the real issue is you have to look at the contracts, and you have to look at the design of the underlying chassis. Mm-hmm. And then you have to look at the specifics of the construction of those products. And so if we start with the chassis itself, Universal Life versus Whole Life, mm-hmm. The formula for life insurance, for cash value life insurance, is the premium plus the investment returns are equal to the expenses plus profit.
Okay.
Okay, so it's an algebraic formula, if you will. So when you say the expenses plus profit, you're really talking about, from the insurance company's perspective, they've had to cover the mortality expenses, they've had to cover the investment expenses, the administrative expenses, the commission and distribution costs. Mm-hmm. They have to set reserves aside, and there's an opportunity cost to doing that at times. And they have to make a profit. From the client's point of view, it's the death benefit. So if I look at it either from the insurance company's point of view and took a snapshot of all the existing policies in force at a moment in time, or if I look at it from an individual perspective, one policy through the lens of time, I can do it either way, and the formula is still accurate. And I've gone over this at length with the senior actuary of a very major mutual company, mm-hmm. and he verified its accuracy. And so when I think about most individuals that are paying a premium, there's an expectation that the insurance company will take the money and will invest it over time so that at some point down the road, the client will get a death benefit back that is substantially greater than the premiums they paid. And what makes up the difference is the growth on those underlying premiums. And that growth came because the insurance company managed the pool of assets, and that's how the growth occurred. And then they end up paying it back over time, at a period in time, at death, to the client. It doesn't matter if it's whole life or universal life. Both of those contracts have the same formula. The major differences, though, have to do with the contract language. And so before we dive into that language, what is a contract? It's a legal agreement between two parties, right? That's what a contract is.
Sure.
And so a policy, in effect, is a legal document that spells out the obligations of both parties.
Okay.
So when we look at the obligations under a universal life contract, and it doesn't matter if it's traditional universal life, if it's variable universal life, if it's index universal life, all of them are essentially the same in the underlying contract on the chassis.
Mm-hmm.
So first and foremost, the premium, right, the big benefit of universal life is that it's touted to be very flexible.
Right.
Meaning the client has the ability to raise and lower the premium at will. Now, obviously, if they lower it to zero and there's not enough money in the contract, there'll be a lapse. But
Sure.
But the flexibility that's touted on universal life, and another name for universal life is flexible premium life.
Right.
Right? I mean, that speaks to a purported benefit.
Who doesn't like flexibility, right?
Right? It sounds great. I like flexibility. If I were more flexible, I'd have a better golf game, but that's a whole different story. So anyway, when you look at the contract provisions of universal life, you have that flexibility. Mm-hmm. On the investment side, you have a minimum, but if you run an illustration and you show the minimum rate of return that's promised, and remember the formula, on the other side is expenses, right? The contract spells out, universal life contract spells out maximum expenses. So if you run the guideline premium, under most contracts, there are a couple of exceptions, but the vast majority, you run target premium, guideline premium, right? At the minimum rate of return and the maximum expenses, what happens to those contracts?
They lapse.
They die before the client is expected to die. They lapse.
Right.
Right, because there isn't enough money in the contract. So one of the problems that universal life has is that flexibility cuts two ways.
Sure.
Because the insurance company has the ability to go to a client and tell them, well, you know, the underlying assets have not performed at the level that we expected. And our expenses are where they are, might be a little higher, might be a little lower, but we don't have enough premium to cover the expenses because the underlying investment growth was not sufficient to create enough money in the pool to offset the expenses. And one of the problems and one of the reasons the expenses get bigger and bigger and bigger is that mortality expenses over time are a huge component of the costs within a policy. So it's an exponential curve, right? Mortality expense.
Mm-hmm.
So what happens is, if you think about it, the reason it's exponential is if you look at the curve where the T in time is,
Sure.
you know, the assumption is people are young. And so if you had 1,000 30-year-olds, you know, really one or two may die in a year, but not that many are going to die. Mm-hmm. And if you look at where the arrow is to the far right of time, let's assume that's 70, 75. So you have a number of people that are dying. But think about the number of 70-year-olds that die every year compared to if you had 1,000 90-year-olds how many more of the 90-year-olds would die compared to 1,070-year-olds?
Sure.
Right? And so then go to 100. So that curve really almost goes straight up,
Hyperbolic, yeah.
right, at some point in time. And so if you don't have enough money in the pool from the investment returns, the only place the insurance company can get the money to cover those internal expenses is by going to the policyholder and saying, you got to pay us more premium.
Right.
And because that curve begins to go exponential, the amount of premium dollars that are required at that point in time can be substantial. And so there are many documented cases of individuals who had premiums that they had agreed to that might have been $10,000 or $12,000 a year, that due to the underperformance or lack of performance in the investment return bucket, got premium notices from their insurance companies, and those premium notices were $30,000 a year, $35,000 a year. And each year, Sean, because the curve is exponential, each year the premium requirement is higher and higher and higher.
Does that go up exponentially as fast, or do they try to?
No, it goes up as fast.
Wow.
It has to. For example, I remember back in the old days, we used to sell a product called ART, Annual Renewable Term, or YRT, Yearly Renewable Term. And I remember seeing that the premium at age 99, the premium for a $100,000 term policy was over $99,000.
Interesting.
Well, think about that. They wouldn't sell it to you at 99.
Yeah.
But that's the only way they could cover that expense. Guess what it was at 98? It was almost 99,000.
Really?
And so what would you do? We paid 98,000, 99,000, 2 years in a row to get 100,000 in the third year? Well, nobody's going to do that.
Sure.
So part of what they're trying to do is get people out of those contracts.
Mm-hmm.
And the reason being is if they don't have to pay a death benefit, they're better off.
Sure.
Let me say that again. If they don't have to pay the death benefit, they're better off. They've had the full use of your money from the premiums. They've collected fees by managing the assets.
Mm-hmm.
And if they, at the end, the contract lapses and they've had the use of the money, they've gotten fees off of the pool, and the pool ended up drying up and they don't have to pay out a death benefit, that's not a bad deal for the insurance company.
Sure.
Right? And so that flexibility is really a knife that cuts two ways.
Yeah. So, it's interesting to me. It's almost like they're forcing a shift in risk from the company to the individual at a certain point in time, and really kind of pushing that risk back on the individual.
Well, totally. In fact, a number of these contracts, when they were designed under what's called in the industry lapse-supported assumptions.
Okay.
Meaning that they knew that when they priced it, that a substantial percentage, and it's proprietary, every company has different proprietary assumptions, but that a significant amount of the policies would lapse and they would not have to pay a death benefit. And because of that, and because they'd been able to collect fees all along the way, they were able to price the premium lower than if they were under 100% assumption of having to pay out everyone as a claim.
Sure.
And one of the challenges in the industry is that some people are biting a bullet and they're paying the premiums, and so they're actually having poorer results than they had originally anticipated with the original assumptions.
Man. So the UL product then, the UL chassis then, seems to me that it's, like you said, it's not a bad product. It's a great accumulation vehicle, but it has to be managed.
Correct.
For the next phase. So what do you recommend as far as that management piece? How do you fix the problem, so to speak?
Well, it depends on the type of contract.
Okay.
It depends on if it's a traditional UL, a variable UL, or an index UL. And before we get into the specifics of the type of UL, let me just compare and contrast with whole life.
Okay.
Because at a chassis level, this is the biggest difference. Whole life typically has a premium that's 10 to 15% higher than target universal life. And so think about, be the insurance company for a minute and put yourself in their shoes. If I were to contract with you, Sean, and say, Sean, I'm willing to give you 10 or 15% more premium each and every year, what will you give me in return since I'm giving you more upfront money?
Okay.
Well, what you're willing to do and what's in the contract is some guarantees, some very explicit contract guarantees that say, no matter what happens, we can never, ever, ever raise the premium, period, end of story. You can lower the premium at points in time. You can pay less, you can pay nothing at different points in time, but the insurance company can never come to you and say, Sean, we need to raise the premium above what you originally contracted.
Nice.
So that guarantee alone, Sean, is a guarantee that is worth the additional premium.
Sure.
But there's more. In addition to that, what they're saying is, regardless of what the investment return is, if you pay the base premium, we'll pay the death benefit no matter what. So they have a contractual guarantee that as long as you pay that premium, they will pay the original death benefit that you contracted for. There may not have been any growth on it, but they will pay at a minimum what you originally contracted for when you signed up and were underwritten for that policy.
Got it. Got it.
But here's the best part. If you get the investment return that they anticipate, there's going to be growth in the contract. So that means that your death benefit and your cash value could grow. They can't guarantee it because nobody knows what interest rates will be in the future.
Sure.
But it could grow above and beyond the schedule, the minimum schedule that you agreed to when you first contracted with that policy.
Okay.
But think about this. If the investment returns are better than they anticipated, you get all the upside. So what that means is the guarantee says they guarantee the premium can't go up. They guarantee a minimum rate of return. They guarantee they'll pay the death benefit. And if they do better than anticipated, you get all the upside.
Wow.
All the upside. And because we work with mutual companies, that means the policyholder is an owner of the company. The company has zero incentive, has no incentive to scalp the policyholders. Because if they did, Sean, they'd have excess profits and they would just have to turn around and give it right back to the policyholders in the form of a higher dividend.
Got it.
Right? And so the alignment of interests between the company and the policyholder is much closer with the mutual company. But more importantly, when you know going in what the worst case scenario is, and you get all the upside from there, that's why that additional little bit of premium is such a bargain.
Sure. Basically, what you're saying is that those guarantees are the way that they are because of the language of the contract specifically?
Correct.
Got it.
So it's a contract. It's a legally enforceable document between you and the company.
Got it.
And not only that, but these companies mutual companies that sell whole life have been in business for nearly 200 years. And so they have a very proven model that works.
So what do you say to someone who has been accumulating cash in a UL or an IUL type chassis and, now they're faced with possibly increasing charges and expenses inside the contract, which just eat away at that cash? What is what do you tell people as far as how best to manage that?
Well, I think you have to look at how most of those contracts are sold.
Okay.
When most people look at those contracts, they bought them as an accumulation vehicle, not as a death benefit product.
Sure.
Meaning, yes, indeed, if they die early, they want to know there's a death benefit, and the fact that that death benefit is paid income tax free to their beneficiaries is phenomenal. It's awesome, and I will say, Sean, you know, the question was asked one time, well, what's the best kind of life insurance to own? And there's only one answer. That's a kind that's enforced the day you die, right? That's the best kind to have, and which is why some of those contract guarantees were important. But if I bought it as an accumulation vehicle, then the issues I have to be concerned about is how realistic are those expectations? Because I was shown an illustration. How realistic are those illustrations? Number one, on the accumulation side, but an awful lot of those contracts also show income streams in retirement.
Sure. Tax-free income streams.
Right. And so that's there are two sides to this. Number one, how realistic are the underlying accumulation assumptions? And then secondly, how realistic is the stream of tax-free income projection once I do hit retirement and want to take income from those products? And so, and I want to focus on index UL because what we saw back in the day, in the late 70s, when traditional universal life came out, they were sold hand over fist because interest rates were at all-time highs. When you look at the history of interest rates in the early 80s, I can remember seeing 14%, 16%, and those were interest rates. Those were CD rates. Those were, 10, 12% tax-free muni bond rates.
Yeah. Mortgages were 22% and those bonds were 17 or whatever.
Right. I remember I was working for my dad, and he had a line of credit at the bank, and it hit 22% on the balance, and he was going out of his mind. Well, when you're an investor, you're the insurance company, right? And you can own bonds with those coupon rates. That's a phenomenal deal.
Sure.
And so it was very easy to illustrate universal life contracts that were outperforming in-force whole life contracts. And so it was an easy sale. What happened, though, is a couple of things. Paul Volcker was made the head of the Fed, and he absolutely was bound and determined to destroy inflation, and that's why interest rates went as high as they did. But inflation died in its tracks. Bond rates came way back down. Well, guess what happened when bond rates came back down? The companies that had issued those bonds figured out, well, wait a minute, we've got, Sean, outstanding bonds out there at 16%. We can issue new bonds at 10 or 8 or whatever the rate was at the time.
Sure.
Why don't we exercise the call provisions in those bonds and replace them with this cheaper debt?
Yeah, just swap them out.
And so what happened is they exercised the call provisions, and very few were issued back then without call provisions. So the insurance companies that had bought those high-yielding bonds ended up having to cough them up and exchange them for lower-yielding bonds. And when you look at the algebraic formula here, if you were using 16% as your investment rate of return on, say, a $1 million death benefit policy, how low do you think the premium was? If you weren't getting 16 anymore, and now you're down to 8, and you still have that $1 million death benefit, what had to happen to the premium?
Yeah, had to go up.
Right. So what was happening is people were getting significant premium increase notices, and they weren't even close to their own expected mortality. Because, people like cheap, and they went in cheap, and cheap turned out to be not inexpensive.
Yeah.
So, those kind of went by the wayside when interest rates normalized. Well, that was about when if you look at the returns between 1980 and 2000, as interest rates were coming down in the mid-'80s, the market was beginning to take off.
Sure.
And we had Black Monday in '87, but that was a very short duration correction And the market pretty much looked like that exponential curve on your chart over that next 15-year period of time.
Sure. So you have a great rotation. Everybody gets out of those bonds,
Correct.
starts throwing money in the stock market,
Right. What did the insurance companies do?
create a new product.
Well, if bonds don't work, what if we put investment accounts that are like mutual funds? They call them separate accounts. And so instead of bonds, well, we can just invest in the stock market.
Right.
Which, Universal Life came about because there was a Wall Street brokerage firm named Hutton that was working with Michael Milken and the junk bonds.
Yep.
And they needed a way to sell them, and so they convinced insurance companies that this whole new Universal Life product would be a great place to warehouse these bonds. And look how much money the insurance companies could make.
Sure.
So anyway, that's just a little historical aside.
Yeah.
So anyway, now we're going into stocks and, the dot-com bomb and whole deal. And so agents being agents were selling variable universal life, which was basically a YRT product, yearly renewable term, with a side savings account, which was the separate accounts, the mutual fund type investments,
Sure.
in a tax deferred wrapper.
Interesting.
And I remember having a conversation with an agent who was showing 12%, and the conversation went something like this, Sean. Well, everybody knows that 14, 16, maybe even 18% a year is pretty easy, so I'm showing 12 because I'm conservative.
Right.
So I remember sitting across the table from this guy thinking, buddy, you're an idiot. But he was a young idiot, and he hadn't lived through the market in 74 when it had contracted, or even 87. And, it was all roses and sunshine at the time.
Yep.
So guess what happened? We've seen a number of contracts that, because they were based on 12% or 10% rates of return, the premiums were underfunded. That because of the severe contraction in 2000, the relative lost decade in the market over the following 10 years, that they now find themselves at a point in time that when you project at reasonable rates of return from today forward, the policies lapse before normal life expectancy. And so we see a number of clients that are now faced with the choice of either funneling quite a bit more money into the contracts or trying to get out of those contracts into something more stable, more suitable.
Yeah.
Sadly, a number of those people now are 10, 15 years, 20 years older, and they have health issues.
Yep.
And
Either nearing retirement or actually in retirement, most likely.
well, or even in mid-50s. I mean, you think about, sadly, the number of Americans in their 50s that are taking statin-type drugs.
Yep.
It's a pretty big number. But anyway, that's the issue there. So when people saw that there was the volatility in the market scared people, some really bright people figured out, well, we still like the ability to collect fees. We still like the ability to have tax-deferred growth. How can we do this and tell people we can pretty much guarantee that you won't lose money in the investment account? And they created Index UL. And if you understand what happens in an Index UL contract, the life insurance company takes the premiums that are paid, and they back out a policy fee and the administrative fee and some of that, and the remaining premium goes into buying bonds. So if you think about bond rates today, it's pretty low.
Sure. I think the 10-year is down. It hit a high of 2.8%, but now it's back down to like 2.65 or something.
Right, and so even 30-year high investment quality corporate bonds are pretty low.
Sure.
And so one of the challenges that all insurance companies have is that the more money they take in the form of premium, the faster their overall portfolio rate goes down. And we've seen over time as bonds have matured and they've had to be replaced with new bonds, that interest and dividends from insurance companies have trended down along with the downward trend in interest rates. While there's no question that what the Fed has done to keep interest rates low has helped the mortgage industry, it's certainly helped the banks. It's come at a cost to insurance companies because their portfolio rates have trended down as well. But what the insurance companies do is they invest in bonds and then they take bond interest, and with that interest they buy hedges on the market. So they're buying options, puts and calls on the market, and that's how they're talking about being able to have some return that tracks market returns. And so common sense says a couple of things. Number one, in a low interest rate environment, if the premiums are buying bonds and the yields on those bonds are down, how much money is really available to buy the options to do the hedging? Secondly, if it were really easy to do that and to lock in market returns, why doesn't the insurance company do that with their entire portfolio? But thirdly, when you look at markets and you look at the costs of bonds, of options, when you have periods of relatively high volatility, such as what we have now, the cost of those options tends to be higher than in calm times. And as a result of that, there have been a number of people who have really looked at the realistic expectations and looked at what the industry has experienced with indexed annuities, because indexed annuities have been around longer than indexed life.
Sure.
And so there's a greater track record on that, both in terms of costs of hedging and performance. And here's what the takeaway is. There's a noted industry expert, Sean, by the name of Bobby Samuelson, and he consults with insurance companies and speaks to a number of different industry groups. And he's written a number of papers on the subject, and his prediction, if you want to call it that, is that the real rates of return on index life policies will be, best case, 50 basis points. In other words, 0.5%.
Wow.
Higher than the fixed account rate. That is kind of net performance.
Oh, got it. Got it.
So my point is this: the fixed rate is net of the bond acquisition costs.
Okay.
So what's the fixed rate in most of those contracts today?
2%, I think. That's the floor. Is that what you're calling the fixed rate?
Well, generally, some of them are crediting more, 3, and you may even give 4.
Sure.
So 0.5% more than that tells me that they're really looking today at somewhere between 4 and 5%.
Got it.
So my question to you is, how many index UL contracts out there were sold illustrating 5%?
We illustrated 6 and used that conservative line.
Right.
You know, the market is averaged 8.25. We're showing you 6 to be conservative.
Right. So, you know, what you get when you say the market's averaged 8.25, that's a 20-year look back. A significant part of that 20-year look back is the best 6 years the market ever had in the history of the market.
Sure, the S&P run-up.
Right. The other thing that most people don't understand about the S&P is that when you do a look back, that one of the things that happens is the makeup of the S&P changes over time. And so the S&P going forward is not going to be the S&P of days gone by.
Got it.
And the last thought on that is it's the underlying value of the index, and it does not include any dividends from any of the underlying companies or reinvestment of those dividends. Right? And so
It's just pegged to a number.
so does that say that that you couldn't get 8%? No, it doesn't say that at all.
Yeah, what are your thoughts about, the last 5 years you just mentioned, what was it, CNBC and Fox Business and all the talking heads on TV were so excited because the 5th-year anniversary came from the crash, and they were saying that the S&P was up 150% in the last 5 years since the crash. What do you think about that in terms of those IULs? Are they capturing that return?
Well, when you talk in terms of percentages, a couple of things come to mind. Sean, if you had $10,000 and you had 100% gain, how much do you have?
20,
If you had a 50% loss, how much do you have?
10.
Right? So when we talk about percentages, the market's up, 150%.
Yep.
It's up 150% because it went down 45%.
Right. Got it.
Right? And so it's higher than it was, but if you levelize it across time, right, it finally went above where it was in 1999 just a few months ago.
Right.
So we have to look at some of those numbers. So are they capturing some of those gains? Yes, they are. Are they capturing all of them? No, because many of those contracts have caps and participation rates. And the reason they do is because if you only have so many dollars that you can use to hedge, right, you kind of max out your ability to capture all of the gains.
So the cap rates, I believe, when we were putting our clients into these IULs, I think the cap rate was 10.5.
Okay.
The floor was 2. So over the last 5 years, if they've gotten 10.5, 10.5, 10.5, 10.5 for 5 consecutive years, well, who knows if that happens because it's point to point.
Well, that's that. Now, see, now you're getting into it, Sean, because if the market went up, in order to get the 150%, if the market went up 18%, you missed out about half of it.
Yeah, because you started in June, not January or whatever month
Right.
you started.
And the second thing on the point to point is it's a point in time, and so depending on when that run up was, and if you look at the market, the big run ups are on a very small number of days out of a year that caused the bulk of that.
Sure.
So you may have been on the right side of that, and you may not have. Will everybody be on the right side? Absolutely not.
Right.
Which is why Bobby Samuelson says that if you look at the vast majority of those contracts, they're going to do about 0.5% better than the fixed account
Got it.
because of all those ongoing issues, right? If you're buying a hedge, you're really buying an insurance contract,
Right.
that allows you to participate in a certain gain in the market. If there's no gain, you paid money for that option and it goes by the wayside, it times out, and so that's an expense, right, that the company incurred, and they got zippity-doo-dah in return for it.
Sure.
So that expense has to be allocated within the overall gains, which is why when you read the fine print on those contracts, it says we may change at our discretion. And if you read the initial proposals with a highlighter, and wherever it says the company may change or we may change, if you highlight that, you'll be shocked at how much yellow or orange you end up seeing.
Yeah.
But let's talk about distributions. If you were going to look at a lot of these contracts, right, and I've heard them marketed as super Roths, where you can put as much money in you want, then you get tax-free income, right? And it shows these huge amounts of money coming out year in and year out in retirement. And it's income tax-free because they're policy loans. So let's talk about, first of all, distributions from a fixed asset with a guaranteed growth rate versus distributions from a variable asset that has volatility.
Okay.
So if we were showing it was going to grow at 6% a year or 8% a year, and it gets to be some big number, and it's still growing 6% a year, but we're only taking 5% a year out, well, in theory, we can take a lot of money out for a long time.
Sure.
But what happens when you have a 0 year, right? You're not going to have a negative year in the market, although you could have a total negative year if you had a 0. You say the market had a negative return, so you had 0, but then you have to back out mortality and other administrative costs. So technically you did lose money. You just didn't lose it in the market.
Right.
But your account is lower. And on top of that, you pulled out $200,000 a year because that's what the illustration said. So think about this visual. Sean, have you ever stepped on an ant pile?
Yeah. Yes, I have in Texas.
Right. So think of all those fire ants. They get all over you, and then, they all start biting at the same time.
Right.
Right. So before you stepped on them, what were those ants doing?
Minding their own business.
They were working.
Yep.
Right. They were procreating. They were working. They were getting food, and they were doing whatever ants do.
Sure.
So if you think about a withdrawal, what a withdrawal really is the neighborhood kid coming and pouring a little kerosene on the ant pile. So what he really did was killed off some of the workers,
Right.
right? Because you took them out of the pile. They're gone.
Right.
So if you had a 0 year, and on top of that, now you're also doing a withdrawal, right? You really have less than you started with.
Less productive dollars.
Right.
Got it.
And so if you continue the withdrawal at the rate that was forecast, even though you might average 6%, because you're taking withdrawals out in a flat market, a 0 market, you're killing off the little productive workers, and you run the risk of running out of money.
Sure. Now you're talking about a traditional retirement account?
I'm talking about that, or if you're doing policy loans, it's in effect the same thing.
Is it? So you don't?
It's really exacerbated because you have an interest component on top of the withdrawal.
It compounds as well.
Because you have compound interest on the loan.
Sure.
So you have the withdrawal plus the compounding of interest on that loan and every prior loan.
Sure.
So it's even worse when you're doing policy loans than if you're doing regular withdrawals because of the interest component mathematically. And so the challenge that we have is there's a software package out there, and it allows us to test different assumptions. And I tested 10 or 12 of them right after I got the software package. And it allows us to put in the premium, the illustrated rate of return,
Okay.
and pull out the illustrated withdrawal rate. And then it does a Monte Carlo simulation, right, which is a stochastic statistical analysis is the technical term,
Sure.
which basically you run a whole bunch of different sequences and determine the probability of success or failure. And the best one I got, Sean, showed an 8% probability of success.
Wow.
8%.
Meaning 92% probability of failure.
92% probability of failure under the assumptions, right? The premium level, the rate of return illustrated, and the money coming out to fund retirement. 9 out of 10 of them statistically would probably, and again, you can't forecast it because nobody has a crystal ball, but using probability theory, 9 out of 10 of them would not be able to yield that rate of that level of withdrawal in retirement.
Got it.
More importantly, on one of them that was showing $250,000 a year premium being paid for, a fixed number of years, In order to have the level of withdrawals that were illustrated, the client had to have paid about $450,000 a year of premiums over that same duration. So the premium was just slightly over half of what would have been needed to have the withdrawal with a much higher level of certainty.
In other words, they would have to pay more of their cash into the policy in order for it to work?
To get the projected withdrawals in retirement, they would have had to put in almost twice as much money initially and along the way.
Wow.
So it says that it was a very exaggerated illustration.
Sure.
And yet, it was in tune with the majority of the ones that I looked at. And again, it's a very small sampling, but I was convinced at that point that what I knew to be true, with that additional evidence, I would have been a masochist to keep looking at them over and over again.
Yeah.
So what are the lessons from that? The lessons are they horrible vehicles? No, they're not. Is there a place for them as an accumulation vehicle to have money grow tax deferred? Absolutely yes. Is there a place for them as a death benefit product? Absolutely yes. Are they the panacea, be all, end all that many agents are calling them, and the way they're being touted in the market? Evidence would suggest, and the experts would suggest, absolutely not.
Right.
Why? It's a universal life contract, which does not have the guarantees, and many of the assumptions, in light of what we know today, appear to be overblown. Now, what can we take from that? Well, one of the things we can take is that they have had some benefits, and that there has been a favorable period in the market because we've had a very aggressive central bank keeping interest rates very low and injecting $1 trillion a year into the banking system. That's been very favorable for the market.
Sure.
Will that continue forever? I don't know. Probably not. Secondly, we've got a bull market that is 5 years old now, and typically that's about the duration of most bull markets. Does that mean that it won't continue beyond that? No, that's not what it means. But what it does mean is historically we're kind of, seeing an aging bull. But this time could be different, maybe. I just am not convinced that it will be.
Sure.
But what I would say is that using the capital reserve strategy and using whole life insurance and being able to 1035, meaning a like-for-like tax-free exchange into a contract that has guarantees, could be a solution for many of those clients.
Sure.
And I say that because, number one, if they're insurable, they're able to transfer any gains income tax-free and maintain their original basis in the new contract. The second thing is, as you've talked about with many of your clients, Sean, is the contractual guarantees in whole life mean that they know what will happen to them, not just in 10 or 20 years, but down the road when they're in the distribution phase of their lives. And the last piece that makes this so important is the liquidity that they have with policy loans will allow them the opportunities to utilize their capital as they see fit without restrictions. That's the beauty of using the reserve capital strategy. And that's really the beauty of having an underlying chassis with guarantees like whole life. We've covered an awful lot of the waterfront, and I know I've left something out. So what questions come to mind?
On the distribution phase, when people are nearing retirement or thinking about retirement, what would you say is the best strategy or solution for those folks to maximize their income at retirement? Is it dump it into a new policy, or is it use something else?
Well, I wouldn't wait that long, Sean.
Okay.
And the reason I wouldn't wait that long is that if you look at the real return in a whole life contract over time, it's historically been about in the same range that Bobby Samuelson expects the real returns to be on index UL.
Okay.
The second thing is that if you wait, you really run the risk of not being insurable. And we see time and time again that the closer people are to normal retirement ages, the more health issues humans tend to experience. And so it doesn't necessarily mean they couldn't get a contract, but instead of preferred, it might be standard. Instead of standard, it might be table 2, table 4. And so they really run the risk of either not qualifying or not qualifying for as good a rating as they could get today.
Got it.
And I think the last thing is that one of the concerns that I have is that if you really look at the way most IULs are sold, it's put money in a box and watch the box. It's a pretty box. It has ribbons on it, but really don't touch the box until later on when you're going to empty the box.
Right.
And I think that's a mistake. I think that most of the people that we know have a need for liquidity, have a need for velocity to their capital. They have a need for a reserve with which they can take advantage of opportunities or they can deal with problems or emergencies. I think there are only so many opportunities that life presents to most people. And if you have ready and liquid capital, just having it available is 90% of the battle.
Yep.
And so I think when you look at the reserve capital strategy, the vehicle itself is crucial because it's what gives you the ability to partake of those opportunities, because you know how and why the underlying chassis is going to behave the way it does.
Yep.
And that's really the biggest issue to me when you're putting your faith in a company that holds the levers, meaning the contract guarantees do not exist, right? And so fast forward 15, 20 years, and the president of the company with which you have an IUL contract is under pressure to meet earnings deadlines. Would they have any incentive to ratchet up internal expenses in your contract?
Absolutely.
Would they have any incentive to ratchet up mortality costs in your contract?
Absolutely. Especially if you're a good paying customer.
If the contract says that they can put caps or participation rates in at their full discretion without having to justify to you why they're doing it, would they be tempted to keep a little more of the gain for themselves?
Sure. I mean, like I said, a lot of these contracts, the cap is 10.5% when the S&P was skyrocketing, 20, 25, 30%.
So my point with all of that is, if you're content with putting money in a box and leaving it in the box and hoping that everything will turn out okay, IUL is not a horrible way to go. But the good is the enemy of the best, Sean. And if having the ability to take advantage of velocity of your capital, liquidity, of knowing what the contract guarantees are, and more importantly, how they protect you as a consumer, right? How they don't put the levers 100% in the insurance company's hands. And particularly when you're working with a strong, great mutual company, then what happens is you're really stacking the odds in your favor. The reason people have liked the idea of Index UL is that they get caught up in an idea that I call an either-or idea. Sean, either I can give my money to Tom over there and he's going to put it in the market or whatever, and I don't like the idea of losing money, or I can give it to you over here and put it in this Index UL.
Right. And still chase those returns. I think the returns are the main attraction.
Right, and the protection against the downside loss.
Sure.
The reality is It's a both mentality with the reserve capital strategy.
Yep.
And that's why whole life is such a powerful underlying vehicle. And it boils down to what's in the contract that's legally enforceable to protect the policyholder.
Got it. Got it.
Sean, I'm very encouraged by what you're doing to get the message out. You know, I really, man, I want you guys to just absolutely help these people.
Yeah, I'm excited.
Well, it's fun to do, and I love what you're doing, Sean. So
Awesome. I really appreciate it.